Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday.
Hello and welcome to this week's episode of the Prime Property Finance Podcast. My name is Mark, and in today's episode we're going to take a look at the swap market, or indeed the mortgage interest rates, and what actually is going on at the moment. There's a lot of turmoil in the marketplace due to global events, and I just thought we'd take some time to explain exactly what's happening. So if you've looked at mortgage interest rates recently, thought, well, what's going on here? You're clearly not alone. Deals are being pulled, rates are moving really, really quickly, almost daily, and it's really, really unpredictable at the moment. And what I'm seeing is people either rush decisions or they're sitting on the sidelines waiting for things to settle down without any real clear understanding of what exactly they're waiting for. Often it's on the hope that interest rates will come back down, and that may not actually necessarily be the case. So in the next 10 minutes, I'm going to break down exactly what's driving mortgage rates right now and allow you to make sense of it, basically. So let's dive straight into it then. Now, most people think the mortgage rates are set by the Bank of England base rate. And whilst that is partly true, it's not the full story. So it's not the main driver behind all interest rates. It doesn't influence actually that much in terms of fixed mortgage rates. So where the Bank of England base rate is relevant is around tracker mortgages, which are often a margin above base rate, as that's your pricing, or in a variable rate of some description, so discounted or that sort of nature. Okay, these are often linked to the base rate. So if it goes up, your rate goes up, and if it goes down, your rate goes down. Now, fixed rates, on the other hand, are driven by something else. So if you're looking at fixed rates, and invariably most people are looking to fix their rates, the real driver here is something called the swap market. Okay, so we've done stuff like this in previous episodes, but I thought it really important that we cover this again, given the turmoil that we're seeing in the market and trying to give some clarity around what the key drivers are to this. So let's start then by looking at what is actually the swap market. Okay, what is a swap rate indeed? A swap rate is basically what it costs a bank to borrow money at a fixed rate over a set period. So it would be that 2 or 5 years, whatever the mortgage term is. Okay, and we're talking specifically about the fixed rate term, to be clear. Okay, so before a lender gives you a 5-year fixed mortgage, they need to secure their own cost of money for 5 years. So aside from banks, who often lend their own deposit monies, a lot of lenders act as intermediaries, have their funding lines. Now, they may need to go to the money market to borrow that money, to the swap market. They will then borrow that money at a fixed price. They then make a margin on that, and you borrow the money over that. So that's where the profit sits. So actually mortgages, when you think about it, aren't actually that profitable in terms of the number of margin that's there. Just like a builder, if they're giving you a fixed price, they've already locked in their costs. Otherwise, they're taking a huge risk. So why does this matter? If swaps go up, the lender's costs will go up. So mortgage rates will also go up. Equally, if swap rates come down, mortgage rates usually come down with it as well. So mortgages aren't guesses. They're basically priced off real-time costs in that sense. Okay. So swap rates are forward-looking. They're based on what the market thinks is going to happen, not what is happening today. So when we're looking at a 2-year or a 5-year, and you may recall that we've had a period where the 2-year and the 5-year, actually the 2-year was more expensive than the 5-year. The reason for that was the short-term prediction on interest rates was far more volatile than the longer-term prediction at the 5-year. Therefore, the markets were pricing in that stability for 5 years, but also pricing in that instability over the shorter term 2-year period. So that's why we would see that. So where we think inflation is going to impact this or what have you, then I'll come on to that in a second. Okay, so the things that do impact the swap rates, okay, are things such as inflation, okay, whether that's up or down. Interest rate expectations, are we going to see the bank of base rate go up? Are we going to see it coming down? Economic strength or weakness. So are we seeing GDP going up? Are we seeing GDP going down? Equally, global events and uncertainty. Okay, we are clearly seeing a significant amount of uncertainty in the world at the moment with what's going on with the US-Iran conflict. That is having an impact globally. And we'll just do a slight bit of a deeper dive into that actually around what are some of the mechanics that are influencing the economy of that on that part. So as this is where things get interesting, because global events that seem unrelated to mortgages can have a direct impact, let's just take a bit of a look now to the US-Iran conflict and what's going on there. So right now, the key issue isn't just rates, it's uncertainty. Okay, so let's look at, as I say, the US and the Iran conflict at the moment. In the Middle East, we've got a major oil supply. The conflict is obviously creating a risk to that supply. We've seen that in the Strait of Hormuz and the strangleholds or the restriction of traffic through there, which is clearly impacting oil prices. And we're seeing oil prices going up. So when oil prices go up, everything becomes more expensive. So transport, energy, goods, and that feeds into ultimately the inflation number, okay, that we're inevitably going to see. If inflation looks like it's going to stay higher for longer, markets expect interest rates to stay higher for longer. And when that expectation changes, swap rates will move. So if we expect to see the price of things going up, that's why we're seeing rates change. And because things are changing daily in terms of the conflict and what that means to oil prices, we're seeing oil prices jump all over the place. That's why the markets are jumping all over, because they simply don't know how to price it because things are changing so rapidly. Okay, this is why we always say that we crave some stability in markets, because that makes it far easier to predict what's going on. The pricing settles down, and you as as borrowers will have a degree of certainty around what your borrowing costs are going to be. Over recent years, we've seen that shift dramatically, whereas we have historically been in a period where it's been pretty stable. We've had low interest rates for 10, 15 years. And obviously now we're seeing what the world actually is like. Okay, so let's move on to what this actually means for investors, so that you can understand what these interest rate changes mean to you. Okay, now trying to time the market, and I alluded to this right at the beginning, is trying to time the market is almost an impossible thing, especially in today's world where things are so volatile. So waiting for the perfect rate sounds like a great thing to do. However, what is a perfect rate? And do we know what's going to happen tomorrow? Clearly not. None of us were expecting this year. All the conversations last year were around base rates coming down as we move into a period of stability. And then obviously this conflict has happened and it's thrown all that up in the air. And now we're back to where we were with all the volatility and rates going in an opposite direction. In fact, the conversation now is such that we anticipate 3 rate increases this year alone, base rate increases. And such is how this has impacted the markets overall. Okay, so trying to time the market is difficult. What you are probably better off doing is making decisive action or taking decisive action now. If the rate works for you currently, then you may want to secure that. In terms of the lending and the application process, what that potentially looks like is you could lock your interest rate in now, start your application process. It's going to go through, it's going to take a couple of weeks to get it underwritten, valued, and on offer to get issued and complete. And if rates go in your favor, i.e. down in that period, many lenders will allow you to go on to the better rate. Okay, some will charge a small fee. There are some lenders that will not once it gets to offer. So that's something you need to consider. However, what it does mean is if rates go up, you then do benefit from the lower rate that you've locked in now. So, as I say, trying to time things is extremely difficult. Very often, rather than waiting and sitting on the standard variable rate for a better rate, that often costs you more in the long run than just making a decision and going on to a rate that's available at the time. Mortgage rates aren't just driven by UK data anymore. They're influenced by global events, which you can't predict. So that ultimately comes back to us talking about making decisions sooner rather than later. Okay, and ultimately sensitizing your deal or sensitizing your deal or your income based on the rates that are available today. And are you comfortable with that? Yeah, so I think the sentiment here is that you need to ultimately plan for reality as opposed to the best case scenario. And as I say, decisiveness is going to save you a lot of headaches and wasted time and avoid unnecessary expense. on that as well. Okay, so I guess the message here is that you can't ultimately control inflation, swap rates, or global events, but you can control your deal and your structure and your risk. And that's where decisiveness comes into it. So once you understand what's driving rates, it stops feeling random. And when it stops feeling random, you make better decisions. As I say, we're probably in this environment now for at least 12 months. Even if the conflict ends now, the damage that's been made to infrastructure and oil supplies is going to influence the cost of things for the next at least 12 months, if not longer. Therefore, I think we are going to see ourselves in a period of higher inflation. And higher inflation means that the base rate is likely to change. That base rate, as I say, will be priced into the swap market. And that's probably what the analysts are looking at also. Therefore, I would not be expecting interest rates to be falling anytime too soon in that regard. Okay, so with that in mind, as I said, it is extremely difficult at the moment. Rates are being pulled left, right, and center. We are quoting clients today with the caveat that this rate is actually only available to today. We are getting less than 24 hours notice with some lenders that their products are being removed. Some lenders have gone completely off the market for 48 hours whilst they just see what's happening with the swap market. They simply don't know how to be able to price their own mortgage products. And as you can imagine, that's causing undue stress for people, especially if you're in a position where you have to refinance, i.e. you need to get off a bridge loan, your product is up for maturity, and you don't want to sit on the standard variable rate and so on. So, as I say, it is a period in time. This isn't going to be forever, but we are going to feel the consequences of this for some time to come, I believe. And our conversation has shifted, as I say, from rates falling to rates probably going back up a bit, in line with what we're going to see in terms of inflation going forward, and how that will potentially weaken the economy in the UK. My advice, ultimately, as I alluded to previously in the episode, is making decisions and being decisive is probably the best thing you can do, locking it in. As I say, changing the rate in the process if it goes in your favor. But what you will then do is secure that knowledge that you've got that rate going forward, get the product completed, and park that to one side and look at the next one. So hope you found that useful. If you have any questions at all, or you want to discuss about any of your own mortgages that are perhaps coming for maturity, or you want to chat around what interest rates are going to look like, especially if you're making purchases or anything like that, then please do get in touch. More than happy to have that conversation, just to have a deeper dive into what we think investors should be doing. And as always, please do like and subscribe if you find these episodes useful. And I look forward to seeing you in the next episode. Thank you very much. Take care.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.